So let's go ahead and get started. Okay. Again, my name is Dave Aquino, and I'm actually the live uh, trading room specialist for microquant and value charts. I run the stocks and options live trading room every trading day. Um, again, a little some more information about me. I'm actually a 1995 graduate of Vanderbilt University in Nashville. I was a full broker at age 23 with Merrill Lynch. It was an exciting time. My assistant was 33, and my mentor was 53. At the same time, he's the same age as my father, so it was very interesting. I was the youngest one in the whole group. Since then I'd spent some more time with Merrill Lynch as a stocks and bonds broker, options broker, and then I moved over to the Vanguard Group. For 12 years, I was a senior advisor in the Vanguard's asset management service, Ultra Group, and primarily what I did was manage not only the mutual fund side, but also the individual, highly appreciated stock side, utilizing options for cash flow, as well as managing tax loss harvesting, issues and cash flow issues with those large portfolios. So that was a lot of fun. Now, I've been with Microquant and Value Charts for over, I'd say, 15 months, and this is the 13th month of the Stocks and Options Live Trading Room. It is now May. So, again, very happy to be with you here tonight. And yes, this webinar is being recorded, and it will be available on the valuecharts.com blog website for hopefully sometime tomorrow. Excellent. Thanks, TD. All right, risk disclaimer. Just really quick, we at Value Charts want you to know that trading and investing carries a high level of risk and is not suitable for all persons. Now, before you trade, you should consider your investment objectives, your experience, and your ability to tolerate risk. Now, the main thing is don't trade with money that you can't afford to lose, and take reasonable measures to trade at the level of experience that you are currently at. Okay? This information is provided for education and assistance in making your own independent investment decisions. Okay? The past performance of any results that are shown for illustration and example only. They're hypothetical and have many inherent limitations. Now, we're not making any representation that any account will or is likely to achieve profits or losses similar to those shown. And most importantly, just understand that past performance is not necessarily indicative of future results. Now, this is CFTC Rule 4.41. It's a government-required disclaimer. Just know that the CFTC wants you to know that trading has, again, large potential risk and rewards. You must be aware of risk and be willing to accept them in order to invest in the futures and options markets. Don't trade with money you can't afford to lose, and this presentation is neither a solicitation nor an offer to buy, sell futures, stocks, options on the same. Again, past performance of any trading system or methodology is not necessarily indicative of future results. If you have any questions on these two disclaimers, feel free to go ahead and contact us at Microquant, and that email address is support@microquant.com. Excellent. Okay, so we're going to go ahead and jump into the presentation. The webinar tonight is covering aspects of weekly power option strategies. Now, again, that's kind of a descriptive name, but what we're going to be talking about, I'm going to touch on these different points. This is why I think we can provide value for your time, whatever level of options trading you are in. Okay, I'm going to talk about some essential Greeks. Those of you that have been around options long enough, you know we talk about Greeks, and they're the aspects of options that dictate the pricing of options as it relates to the underlying securities. We'll touch on the what I consider two of the most important when we're dealing with weekly options. I'm going to talk about the aspect of time decay in options and how that is expressed on a weekly calendar. Again, we are trading weekly options. Then I'm going to go into a couple of different strategies for you. The ones I would like to call the Tuesday weekly credit spread strategy. I'll talk about the background of the credit spread strategy, how we implement it in the room, and give you some ideas going forward. And then the second type of strategy, I'm going to talk about selling volatility premium for income. It's been working really well for us going on 6 weeks now. Have a little bit of bumpiness the past week and a half, but it's the essence of the strategy, and it actually gives me an opportunity to show you how we handle different types of situations. But we'll go ahead and continue from here. Again, if you have any questions during the presentation, feel free to go ahead and type it in the side menu. Again, I will try to address it as it comes up and as appropriate. If I don't get to it, feel free to ask it again at the end. All right, so the essential Greeks. All right, this is, I pulled this off a website. I think it is Investopedia.com. It is actually the Black-Scholes option pricing model. Now, this formula was developed by 3 economists, Fisher Black, Myron Scholes, Robert Merton, in a 1973 paper. The result is, basically, it is the option pricing model that compares aspects of the option and uses it to aspects of the underlying security, whatever it is, whether it be a stock option, a futures option, different kind of options, and then extrapolates a current value for that option. Now, this particular idea, this paper, won the 1997 Nobel Prize in Economics. And again, the Black-Scholes formula is used to calculate the fair value of the option. Again, it's a derivative whose value is based on some sort of underlying asset, and it is best described by its Greek factors. Now, the formula is looking pretty complicated here, but there's a lot of calculators that you can use online to give you an idea. Most software, trading software, calculates all this stuff for you. Okay? All right. So the 2 Greeks that I want to talk about tonight are delta and theta. And again, delta talks about the changes in the option price as it relates to changes in the underlying stock price. And then theta talks about the changes in the options price based on the option's sensitivity to time to expiration. Just to put it plainly, the delta of Greek affects the option price based on how the stock price is moving up and down, all right, and how far it is from the current strike price of the option. Theta is basically when you're talking about options that have time value, that means there's time to expiration, the rate of decay of that time value. Now, if they're out of the money, that basically means that the value of the option only has time value and it degrades to 0. Okay, for those of you, how that have some background in options. But those are the 2 Greeks that we're talking about. There are more. There's gamma. Someone asked me about that the last webinar, and volatility is a big one. That does affect it, and so does rho and I'm missing another one. No, but these are the 2 I want to talk about because they demonstrate quite well how we use them in the weekly power option strategies. Gary, I see your question. How does high frequency trading affect the value of the charts and the trading strategy? I mean, you do. It doesn't necessarily affect the trading strategy because we still trade in the trading room regarding how the underlying moves. We don't necessarily just trade the option with these spreads. We always fall back to the way the stock moves. Now, I know other organizations doing seminars and stuff on high frequency trading. We see some of that reactivity in the stock price, but again, you have to be aware of the effect of high frequency trading on the individual stocks that you trade, but overall, you don't necessarily have that effect in every single stock that we follow. But trust me, there are there are movements in the stock, especially the lower volume stocks. You can see that exaggerated move. But good question, thank you. All right, so let's move on. Again, getting further into the aspect of the Greek delta. Delta, again, is the sensitivity to changes in the underlying stock price. Now, it measures the expected change of the option given a $1 change in the underlying. So if we talk about, and those of you that are familiar, a delta 50, okay, that basically means that stock, that option is right at the money. So the stock price is 500, the strike price of this option is 500. That means for every $1 that the underlying moves up or down, that means the price of the option, with everything else staying the same, will move up or down 50 cents. Okay? Now, when we talk about deep out of the money options, some of you that are maybe newer, maybe you've seen systems that they'll go in and they'll buy the really cheap option, like Delta 20 or something like that. And they're really, really cheap. Maybe they're, $1, $1.50, something like that. They are so far out of the money. They have very low deltas. Therefore, any change in the underlying stock has a very small effect on the price of the option. Now, in order for these options to really make a big move, you actually have to have a very big move in the underlying. This is where people come in and they'll buy these cheap options. Maybe they're 25, 30, 40 cents. And all of a sudden now they're worth 10. And they'll write, stories of how they went from 20 cents to $10. Well, chances are the underlying moved, $40, $50, something like that. Again, but that is so rare that, most of the time, in factoring commissions and the bid-ask spread on these really cheap options, low delta options may not make a profit, even if there is a relatively large move in the underlying. Okay? Stocks have an average true range that they move in a day. You can even extrapolate that to a week. If you don't have enough movement, then a deep out of the money options probably will expire worthless, very likely, because they have no intrinsic value. They only have time value, and in order to buy them cheap, usually there's not much time value. So that's the one fallacy I've found with out of the money options. I'm not sure. I'm not telling you can't hit a home run, but you're gonna have to do it an awful lot to every once in a while get one of those home runs. Okay, so that is delta. You can see that here at the money, delta is 0.50. When we are deep in the money, we're talking about deltas 70 or or higher. Those are the ones I actually like to trade. But for this trade intraday, but for this particular strategies, I just wanted to introduce you to delta and how it changes based on if it's in the money or out of the money. All right, next is theta. Theta is the measurement of the option sensitivity to time until expiration. Okay, it's a direct measure of time decay. Now this amount increases rapidly as the option approaches expiration. What that means is theta's effect increases as the option approaches expiration when you are at a price very close to the current strike. For monthly options, just keep in mind this is a exponentially degrading aspect of option pricing, is that for monthly options, when we're talking about 3, 2, 1 options that have 3 months to 2 months to 1 month, when we go that far out, the greatest loss of time decay is in the last month, the last 30 days. Now, we're going to be talking about weeklies. So for weeklies, you know, we're going out 6, 7, 8 days. The last or the greatest rate of time decay is in the last 1 to 2 days. So we're talking anywhere from 5, 6, 7 days out. But what's important is the last 1 to 2 days. Okay? Now, majority, you probably heard this before if you've been around options before. Approximately 80% of options expire worthless. Okay? So I don't know about you, but I like 80% versus, and then 20% expire in the money. I like this number better. Okay? And it's the reason why it's better, not only because it's 4 times as big as this number, but the way you capture this is that you actually become an option seller. And by being an option seller, we use theta to our advantage in that we're collecting time decay. Basically what we do is we sell something, and after we sell it, it becomes worth less and less and less. So if price never changes and the only thing is changing is time, and time's only going to go flowing in one direction, that something that we sold for $1, the next day is maybe worth 80 cents, the next day is worth 60 cents, the next day is worth 40 cents, 20 cents, and then worthless. Okay? We sold it for $1, so in a way we pocketed that money already, and then it eventually becomes worthless. It gets to the point where we only have 20 cents. We sold it for $1, it's only worth 20 cents. Sometimes we buy that back, but we'll get into that strategy. Okay? So that's what we do with credit spreads. We want to sell premium. We want time decay working in our favor. Okay? Time is a great ally. Okay? If you ever bought an option that's out of the money, you can know the feeling of that option degrading every single day until it becomes worthless at expiration. We just take the opposite side. We sell it. All right. Again, here's the theta, the exponential theta decay of the value portion of an option. Again, this is an out of the money. This is an out of the money. That means there's no intrinsic value. So this is going on 90 days. Okay, 60, 30. Here is 5, 4, 3, 2, 1. Okay, so you can see the steepness of this curve is relatively shallow here. It gets a little bit steeper here, and in the last week it's very steep. Last day it becomes perpendicular. Okay, again, time decay of an out of the money option. So, all right. Any questions on those Greeks? Hey, George. Yes, to answer your question, I'll go into that when we talk about the credit spreads that we do. But just a quick question. Yeah, we don't do any naked options. We always do it with spreads. Yeah, Bill. The curve for the week, it's basically this right here. Where I start here, this is 5. It looks exactly like this. It's just exaggerated. You could probably expand this, and this could be the 5, 4, 3, 2, 1 days. It'd be the same curve. Oh, Victor, sorry about that. No, George was basically asking, how do I protect myself when I'm selling premium from a black swan type event? Do I always do a credit spread, or do I sell naked puts or calls? No, we always do it as a spread. Ron, I don't touch gamma. Gamma tends to be a nice play when we're doing directionals. Theo, I'll talk about that also. That's a good question. You're asking about implied volatility. Yeah, I'm not going to really talk about gamma tonight, Ron. Maybe there will be opportunity in the future. We'll see. Sorry. All right, so we're good on the Greeks. So let's go ahead and get a little more practical, okay? I'm talking about kind of theoretical option pricing models. Again, this is the stuff about theta. I just went through it. The most important thing is when we're talking about weeklies, it's the last 1 to 2 days. The question is okay, if we're selling premium, when do we sell it? Okay? And then again, hopefully you understand why we sell it. Because we want to be in the 80% camp that makes money from time decay. All right? And then again, weeklies, we try to focus that in the last 1 to 2 days. That's what you want to know. All right, so this is the weekly calendar, okay? This is kind of a hybrid calendar because I actually talk about some directional trades too. But when I say that you want to look at this, early spreads, okay, here selling credit spreads, here we're almost late selling credit spreads, and then here we're Friday, we're just managing our closing credit spreads. Generally what happens is this, and this is, I'll go ahead and start talking about the first strategy we're talking about. It is the Tuesday credit spread selling strategy. Do you see how many trading, okay, each trading day is reflected here. So we have 1 trading day on Friday, 2 trading days on Thursday, and then Wednesday is 3. So when do we try to sell credit spreads? We try to do it right around the close, 3 o'clock p.m. to 4, okay, on Tuesday. All right, 3 to 4. Why that time? Well, mainly because we start evaluating the individual stocks, how they're performing as of the end of day on Tuesday. Are they in a momentum pattern that's carrying it higher or lower? Where is the bar going to close when we're talking about a daily bar? So keep in mind, remember, when we're trading, the professionals close the market. So does it close at the high? Does it close at the low? Is it going to settle on support? And with the fact that we know where the bar is going to close, we actually have a closing point on momentum. Is momentum carrying it higher, or is momentum going lower? How many of you saw the market the other day where we pushed higher at the open, and then we went back down, tested the low, and then closed the day higher? So if you tried to put a credit spread here, the day looks different than it does here, okay? If you try to put the credit spread on first thing in the morning, the bar looks completely different. This is an intraday bar, okay? Basically, it looks like this, okay? That bar looks significantly different than this bar to me, all right? This is bullish. This is neutral or bearish even because of the big candle wick to the upside. All right, there's a difference. So that's why we do it right around 3 to 4 o'clock. The live trading room we actually have a special session on Tuesdays. Okay, so we try to do it on Tuesday. Wednesday, we are just Wednesday and Thursday. We're just letting the options settle down and just manage our spreads. And then by either Thursday or Friday, we're either closing the spreads or just managing the position. When I say manage, we just watch, okay? Because this whole time decay, all right, theta, I think this is theta. Theta is bringing the price of the option down, okay? Can you guys hear me okay? Okay, just as long as I'm coming through clearly. Robert, you may want to readjust your sound. On weeklies, I don't normally go out that far. There is I'll show you the other the second strategy. We do a little bit different time frame. But in general, this is how time decays on a weekly calendar. Again, the strongest time decay effect is Friday. But usually when we are doing our strategy, we'll have the opportunity to sell out of our position relatively early. Okay? Again, we have 5 days. Say, well, Dave, why don't we just sell them on Monday morning and hold them all the way to Friday? Well, that's 5 days of risk exposure. I'd much rather sell them on Tuesday, so I don't even count that day. I'll hold them Wednesday, hold them Thursday, and maybe by the end of the day on Thursday, I'm out. See that? I'm in. I have risk on Wednesday and Thursday, 2 days out of a 5-day week, and I still capture most of the money on this weekly calendar. I'll show you more about it on that Tuesday credit special, the Tuesday weekly credit selling strategy. All right, but again here Tuesday, that's the day. It's okay to buy options any days this week because we trade it intraday, but I'm saying in general Monday, Tuesday, Wednesday, those options, if you're just buying them straight, that's probably the best time. If you're going to hold them into Thursday or Friday, it's probably best to buy the ones the following week. Okay? All right. So any more questions on that? Anybody that missed any part of the first half, don't worry. This is being recorded, and I'll be processing it and posting it on valuecharts.com's blog, the video blog. No problem. Thanks for being here. I know some people are coming in off the West Coast, so I appreciate your time. All right, now I've already kind of given you half the strategy already, but again, this is the weekly credit spread strategy. We're going to run through it. Again, it's a high probability trade. It's a swing trading focus because as you saw on that calendar, we're talking about holding a position anywhere from 2 to 4 days. I utilize a daily chart and I evaluate the candidates for the credit spreads based on the current momentum picture, its strength and direction, and then the various support and resistance levels. That's what I use. I'm also looking at the overarching index, either the spiders or the Qs. And I'll tell you, majority of the stuff we do in the live trading room comes from the NASDAQ. Someone asked about implied volatility earlier. For those that you understand, we want a relatively high implied volatility for the actual stock. Why? Because that dictates how much premium we're going to get. And, that implied volatility usually runs anywhere from 25%, sometimes to up to 40%. That's the kind of levels we're looking at. Now, the trading goal for this particular strategy is what I call long-term investment. Okay, it's not it's something that we can do on a consistent basis every single week that helps build long-term gains. Again, it's high probability. Okay, that's a very important aspect of it. All right, now going into, I'm going to touch on the basic strategy. I just want you to understand that selling spreads requires you to look at charts from a different point of view. Okay, we're trying to focus on selling the short strikes that are, and this is an important word, away from the projected price direction. We want to know where prices most likely will not be in the next 2 to 4 days. Where are prices likely not to be? Right? And I will show you a demonstration, so it'd be easy. Just to, again, quick run through the strategy. Profits come from delta. If we have the spread right, prices will move away from our short strike that we picked, because we're also basing it on momentum, and by doing that, you're going to have a change in delta that works in your favor. Okay, the most important day for delta is Wednesday. If we're selling it on Tuesday, we really want delta to work in our direction on Wednesday. Now, again, here's theta again. When we do these spreads, we are selling out of the money options. There's no intrinsic value. And the way, again, this is most strongly affected on the last 2 days of the week. It expires on Friday. So Thursday is a transition point. Delta becomes a little bit less influential, and it shifts more so to theta by Thursday afternoon. Friday, definitely theta decay is in play. Now, when we are very right and the assets are really out of the money, we have a little bit less theta decay because it's the value is already there. Same, yes. Yes, I will show you that. Now, again, because we're trying to do this longer term, the most important aspect of doing these trades is controlling risk. So when we have roughly 75, 80, 90% of our profits, if you sell something for $1 and you can buy it back for 20 cents or a dime, that's when you would consider doing it. You want to get out of the trade and risk and cut your time exposure risk to the trade. If you're not in the trade because you bought your spread back, they can't take your money. That's the most important aspect. All right. And also, if you have $1 and you've earned 90 cents, do you really want to hang around and maybe lose that 90 cents if for the remaining 10 cents? Got to keep that in mind. Okay. All right, let me show you a visual example of this so you can kind of see it. It would take a lot longer time to give you the actual specifics, but it's really easy to see. And I just want you to get in your mind the idea of where will prices not be. Right, so here we see Google coming down. Momentum is carrying it down. It finds a little bit of support here and it bounces. We make this high right up here. Then at 878, and then we come back down. Now the first bounce brought us to 856. The second bounce brought us down here to 845. Now, for those of you that have seen this before, this first low corresponds to this negative bearish histogram profile. Here, this second low corresponds to this histogram profile. And you see that is a bullish divergence. So what we eventually have, and we have right now, say this is the way it closed today, we have prices going higher. We have the momentum picture going higher. So my question to you is, if this is what you see on Tuesday afternoon, where do you think prices most likely will not be in the next 2 to 4 days? Okay, you can't be 100% sure, but most likely, if you have momentum going up and you have the 8 EMA moving up, and we have this bullish divergence and it's working out, up most likely 845 is a good level because that's that previous low. But see my 840, that's where we sold the credit spread. This is what I call the short strike, that we sold the 840 and bought the 835. And we get to keep what's in the middle. Okay? So we get paid some sort of funds here for this move. Normally we sell credit spreads 20 to 40 cents per $5 spread. Okay? I'll get into that specific, but do you understand the concept of selling the credit spread here at 840 where the price will not likely to be because it's going higher? That's what we're doing. Okay? That's what we're doing. We want to see this nice clear picture that the probability it's going to go higher. Now, let me ask you this. Let me erase this. I think I was going to go into that, but what could this possibly do? We're closed right here. The price of Google could go up, maybe at a 45-degree angle. That's most likely what it's going to do. It could go up, rip higher with great news. It could go sideways for the next 4 days. That would be fine by us. Now, what happens if it does this and prices end here? Ooh, it's moving away. It's going down. We thought it was going to go up. We still make money. Okay? We still make money because we stay above 840. The way we lose money is if this thing drops like a rock and in the next day or next couple of days it does nothing but fall straight down, and on Friday we're down here at 832. All right? 832. That's when we lose money. Sorry, I can't write. Not with a mouse. So 4 out of 5 possible outcomes are positive. The one outcome, and we manage that well in the room, loses us money. Okay? Okay, so someone's asking about... Okay. Do I sell the credit spread when the IV, implied volatility, is higher than the HV? Raymond, what is HV? Oh, historical. Raymond, I kind of don't get into that. Honestly, I'm a directional trader. All my tools are set up to help me determine what's the next move in the stock. Is it higher or is it lower? And the parameters that I utilize, as long as I have generally high implied volatility stocks in the range I told you, anywhere from 20 to 40, maybe 50% implied volatility, I leave it to the fact that it's more important for me to get the picture of where the underlying is going. From what I've found is it's good to do all those comparisons, but if you can't determine which way the stock is going to go, you're going to be at a disadvantage anyway. And I show that how when I teach this, that's what I focus on. Now, do I make any adjustments here? Basically, what I do when we trade this strategy, I limit how much risk I'm willing to take based on how much of a loss I'm willing to take in this. If it does start to move down like this, my position starts to incur, quote, a loss, even though I'm not hitting the short strike. I only limit that to a certain multiple of what I can potentially earn. Okay, again, because we tend to pick direction very well, our delta usually on Wednesday moves in the direction we expect. And when we do that, our trades are automatically profitable on Wednesday because of delta, and by Thursday, theta is kicking in because we're moving again away from the short strike. Okay, but we do adjustments. The moving averages, the ones I have on here are the 8 and the 21. Actually, on my current charts, I also have a 50. All right. I do use moving averages and support and resistance levels in my calculation, in the determination of where I put my short strikes. Here's the opposite kind of move. From this move high, there's the second move higher. Here's the upside momentum profile on the first high. Here's the lower one. So if we're looking at CMG right now, right here, what's going on? Momentum's carrying us down. We're pushing down here. Where's prices not likely to be in the next couple of days? Now this is actually taking a big move. Excuse me, a big move already. But I would venture to say this level up here at 540 is a good range to. This is a good location for the short strike. Sell the 540, buy the 545, and this is a bearish call credit spread. Okay, you'd sell the 540 calls, buy the 545 calls, and this is the spread in here in the center. Okay, again, because momentum and price action is carrying this lower, this is where it most likely will not be. Caesar, you can't. You can't avoid events that cause a significant move. If CMG comes out and they basically have been putting, if this was in the opposite direction and they come out with a news article saying that they've been using a poisonous ingredient in their food and it shoots down, you can't do anything. It's like a black swan type event. Now, you do have a limited risk based on how many spreads you have on there. That's why we don't do anything naked. Okay, FOMC earnings. Mainly how we do, first of all, we don't do credit spreads on stocks that have earnings that week. Okay, we don't do iron condors. I'm going to touch on that really quick. But and also, if we have FOMC, depending on how we think the market's going to react, like it did this week, you could have fewer credit spreads out there. You limit your exposure by putting less money on the table. I mean, it's just a smart thing to do. Now, here, let me just quick, because someone's going to ask me about this. But first of all, CMG. You see what I have here? I have value bars. I have a momentum indicator. I have this is a value These are MQ trend dots. I have MQ regression, which is a trend indicator up here. And say this is where we close the night before earnings. Can anybody tell me before earnings, like when we're trading this and then the bell rings and just closes, which way is this going to go when earnings are released? Anybody know? Is it going to be up or is it going to be down? And how much is it going to be up or how much is it going to be down? Just looking at the chart, you can't tell. Eddie or Tim, I'm telling you, this is what it's going down right now. But I've actually seen where it goes down, and all of a sudden, if you look at Apple, right before earnings, it actually moved down intraday, just like that, by maybe 1 bar. Like this is what it looked like the day of earnings. And then where does it do? It gaps up like 30 points the next day, and it's just been going higher. So my point is, you cannot tell which direction earnings is going to move this. It's supposed to. You might have some shady stuff going on, but in general, you cannot determine which way these stocks will move before earnings. That's why implied volatility is twice as much. That's why people think like, wow, it's great, we're going to sell in Iron Condor, we're going to make a ton of money. For you advanced people that do that, I don't do it. I understand the 2 standard deviation move, but Apple moved more than a 2 standard deviation move, and it hasn't come back down, and it's been 4 days. All right, if you had some sort of Iron Condor on that, you're still hurting. Okay. So my point is that's why, just to answer that question, first of all, I don't put a spread on if you have earnings that week, and I don't do Iron Condors. Do I assess likely the market direction when choosing stocks up or down? Yes, I do, Bill. I will evaluate the NASDAQ on the QQQs, that ETF, and if I have a feeling that the NASDAQ in general is coming down, the way I play that is I will try to overweight the bearish credit spreads versus the bullish. Okay? This week I'm actually having some trouble because the NASDAQ it keeps grinding against this resistance level where we're sitting now. I'm looking for the NASDAQ to start to teeter over and come down. The problem is I have 1 bullish credit spread and 3 bearish credit spreads. And you guys know that the market's been pushing. It's a timing thing this week, and it's kind of beating me up a little bit. But in general, when there's a clear indication of market direction, we tend to favor that side or the other. Weeks that we don't know or we're kind of neutral, we'll do even numbers. 2 bullish, 2 bearish, and do it that way. How much premium is left on the call side after that big down move? I'm not quite sure of your question there, Gary. How do I protect against the black swan flash crash kind of event? Aberrant, I don't know. It's not like you run across a flash crash every day. And, how would you protect against a flash crash if you had calls? What would you do? You'd sell them. No, I mean, it's just like if you're long a stock and there's a flash crash and it comes down 5%, what do? Well, you basically get out. Now, there are ways to roll credit spreads, but I'm not going to talk about that tonight. All right. So again, here's one more bearish call credit spread. This is Tesla. Here's the first high. Here's the second high. Here's the momentum profile. We do a lot of divergences type of trades with this. That's how we kind of pick them. So this is coming down, and right here is where we put the short strike, 190. Okay, there's the momentum picture heading lower. So again, it's a high probability type trade because we're trading with momentum and we're utilizing different support and resistance levels. All right, so you can say, Dave, what does this look like? Again, we try to get anywhere from 20 to 40 cents or $20 to $40 per credit spread. And that is based on $500 of exposure. All right, that's just generally what I do. So we try to get anywhere from $20 to $40 on a risk, quote, risk of a $5 wide spread for one contract. You're like, Dave, that's really bad. The reason why it's really bad is because the options that we sell tend to be anywhere from 10 to 15 to 20 deltas out of the money. Okay? What we are trying to do is get a very high probability type return. And you say, well, Dave, it could go against you and you could lose $500. Yeah, I don't. If I'm in it for $20 to $40 worth of gain, I'll be out of the position with a $40 to $80 loss. I don't hold it to 500. I go 40 to 80. All right, I'm willing to lose twice as much as what I'm potentially going to gain, and I let the probabilities work in my favor. Okay, now this 20 to 40%, that's a 4 to 8% return per week. Okay, now just be conservative, don't go crazy. Let's just look at a 3% return. If you're looking at this at the beginning of the year with $10,000 that you implement this strategy with, that results in roughly about a 12% monthly return. After 52 weeks of that, your 10,000, if you compound it, somewhere north of 40,000. Okay? Not bad at all. Okay? After 2 years, you're looking at something north of, again, if we just keep rolling it, of north of 200,000. Now, we're not foolish. If you start out with 10 and you're sitting on 200, you're going to take some of this out and pocket it. All right? But my point is not to wow you with these great big numbers here. That's not my point. What you want to do is develop a consistent strategy that you can utilize to generate an income or make consistent gains in your portfolio. So let's just say you do 10,000 and you have 50,000. If you can still continue to earn 50,000 a year just by utilizing a new 10,000 every year, do you really need to keep increasing the size? You know, when's enough? But I'm not going to sit and preach. I'm just saying that these are what is compounded. Now, I can't promise you that. I can't promise you that's the case. But I'm saying if I'm aiming for 4 to 8 and I'm very consistent, and you keep rolling this over and eventually taking some money out every once in a while, you're going to be on a consistent path of trading. Okay? Gary, I've been trading this this strategy, I guess, just from, as an example, from the beginning of the year. And how many weeks is that? 16. I think we've had maybe one flat week, and the last week was actually slightly down. Yep. Everything else was good. Actually, there are some weeks that the strategy works really well. Come Thursday afternoon, and I'm trying to manage the portfolio. Everything's moving like it is. We're taking profits already on Thursdays. Come Friday, we might just have one spread on because everything's profitable, and that one spread is so far away from the short strike. We're just going to let it expire worthless. No. I'm talking about with a $10,000 portfolio. Okay? You can $10,000 portfolio right there. You will be using 20 contracts. Okay? Whether it would be 1 spread trade, 5 spread trades, 2 spread trades. I'm just saying, taking that 10,000 and you're actually implementing the strategy. However many spreads that you do is up to you. I just have to give you a starting figure so I can show you what it looks like when it grows. Yes, I do, Asim. I have a pretty detailed process. All right, so that is the weekly credit spread strategy. I know you guys have asking some really good questions, and but we're running out of time. So I wanted to have enough time to talk about this next strategy and kind of touch on it because it's a very interesting strategy. If you have a general idea of what's going on in the credit spread strategy, this is what we're utilizing, except we're utilizing a volatility ETF. All right, so just to go ahead and jump right into it, the VIX. Okay, it's based on the volatility index of the S&P 500. Okay, it's also known as the fear index, uncertainty in the markets, and if the market's actually falling, the VIX drives higher. We're going to utilize a VIX ETF to enable the trading in the VIX, and we're going to use one of them that has a high implied volatility. The actual one that we're using currently in the strategy is a 3 times leveraged ETF of the VIX. Okay, because of the fact that the VIX spikes higher when there is fear, uncertainty, and a falling market. Something bad goes on in the world, the market gets scared, the VIX shoot up. Now, because we're using a leveraged position, if the VIX shoots up 1%, our ETF shoots up 3%. But because of the nature of that tendency to shoot higher, we're not going to stand in front of it. We're going to just do a credit spread strategy that only does bullish put credit spreads, because if it spikes higher, that's good for us. I don't want to be standing on this side of it. I'd much be rather over here. Okay, I want it to spike in my favor, because what happens is the VIX spikes higher when there's bad news, and then it tends to grind lower when the market is going higher. Now that's our problem right now. It's just grinding. My VIX positions have been grinding lower, but there's ways to manage that. So keep this in mind. When I say selling volatility, I'm selling a VIX ETF and I'm putting on bullish put credit spreads. Okay? All right. So again, the essence of this is still to sell weekly profits. I'm utilizing a VIX ETF, but here's how it's different. I've found that we actually do better when we sell the bullish put credit spreads roughly 2 weeks from expiration. Okay, and I don't look to close. I don't look to hold it to expiration. I actually sell it 2 weeks out and I buy it back. I close the position 1 week until expiration. That also helps because it helps me manage if it starts to move against me, and it doesn't have as bad an effect. Again, the leverage ETF that I use is UVXY. You guys can look it up. Now again, why do I use UVXY? It's a 3 times multiple ETF, and that actually translates into an implied volatility that's 100% plus. There is more premium to sell. Okay. We've been selling $2 wide spreads, and we've been getting anywhere from 75 cents to like $1 in premium. Okay, that's really good. That's really good. Now here's the thing: we don't try to get the whole dollar. We'll cut it at about a 50% profit. So if I sell something for $1 and I can buy it back for 50 cents, I'm out. I'll take that. That translates to a 25% return on a spread on a $2 wide spread. Okay, for you advanced folks. It's really, and the thing is, when UVXY spikes higher, oh my goodness, these credit spreads. There was 2 weeks ago, I sold a credit spread for 95, right around 95 cents, $2 wide spread. The UVXY spiked 4% in the day, and I bought it back for I made 90% profit. So I bought it back like for $0.10. Okay? I sold it for like 95 cents. I bought it back for $0.10. It was crazy. All right, same thing. This is current picture of UVXY. This was just a couple of days ago. We're actually back down here to 55. That's why this grinding stuff is getting to me a little bit. This was like last week. But again, this is the short strike right around 55 that we're selling it at. Now I have some that are going against me, and I've rolled it back out, and my short strike is right around 52. Okay, so what we are doing, we're selling credit spread, let time decay happen. Because it's a high implied volatility, we get a lot of premium, but that premium decays quite nicely from 2 weeks to 1 week, as long as we're not heading straight down. Okay, when we get a strong move higher like this, We just take profits. That's all. And not so bad. And it's, you can do it because this is the VIX. What you have to understand, if this is a daily chart, you could go back almost like a year. You know that this is really close to his historical bottom right now over the course of a number of years. Now, this strategy is working well because, again, the market is at highs, but it's getting choppy. So the same thing, UVXY could be theoretically thought of being near its lows, but it's being choppy. So I just stay in the position to profit from time decay and these spikes higher. What's CP, Tim? What do I mean by more premium to sell? Caesar, what that means is the options are priced more expensive. Okay? That the options are blown up. They'll say it's like a balloon. Well, one balloon is bigger than the other balloon because there's more implied volatility held inside each one. Okay? Because it's a 3 times multiple ETF, it has a tendency to move a lot. Okay? That's why the implied volatility is higher. But the rate of decay is faster in high implied volatility stocks because eventually those options should go to zero. The balloon should completely deflate. If you have a big balloon and a small balloon, well, the big balloon's going to deflate at a faster rate because it has more air to let out. The same thing with implied volatility. Okay? Do I place... Yeah, don't worry about the current price. This was from the other day. I'm trying to remember the exact day. It's probably like Thursday, Friday last week. Do I place limit orders in between the bid and ask with wide spreads? Basically, I use Thinkorswim, and I look to see what the current spread is. Because I put it out there, and I am also looking at an intraday chart to see how the price is moving. And if I'm selling bullish put credit spread, I'm going to try to sell that credit spread when it's closer to the bottom of the day. If I think it's about to hit the bottom and start turning up intraday, that's when I would prefer to sell the credit spread because that's when the price of UVXY is going to start to climb. Okay. So, but the main thing is, to answer your question, I'll put a reasonable amount out there and I'll leave it there. And let it bounce around a little bit to get filled. It's not a directional trade that I have to get filled right now because it's shooting up right now. Sometimes that happens with a credit spread. Okay? So that's in essence the idea of selling premium, volatility premium. It's selling premium because we're doing credit spreads in the options, but it's using volatility instead of an actual underlying stock. Apple can go up, it can go down. Volatility is based on the what's going on in the S&P 500, but it can be profitable when we have fear spikes that go up, okay, or pullbacks in the market. Right. So hopefully I'm able to answer most of the questions when we're talking about UVXY. Eddie, I mean, you can. I'd be a little bit careful right now with UVXY because the spike. Honestly, right now, I'm in a defensive posture with UVXY. I'm not offensively trying to make a ton of money in it because right now the S&P 500 is at a really critical juncture. Either it's going to stall and fall or it's going to push higher. Okay? There's really been no news in the past 2-3 days that's really should push this higher, but the market is going higher. So instead of trying to keep fighting it, I'm just trying to manage it. And that's what we've been doing in the trading room. And yes, UVXY can be thought of as a hedge. When does the spread becoming a losing trade? When there's an actual negative number? I'm not being a jerk, but I'm just saying. So there are times when longer, it's almost like we have one UVXY trade. It actually has the short strike at 55. The current price of UVXY is around 53. So the spread is like exactly opposite what you want it to be, but I'm not falling yet in the loss, because both the bid and the short and long strikes are kind of maintaining the distance between it. The spread is being maintained. Okay. And that allows me to hold the position a little longer as we get, because I'm 2 weeks out versus I'm not 1 day away from expiration. I'm 2 weeks out. That's why I trade UVXY 2 to 1 week. Okay. Again, it's a very high implied volatility. That's why it helps me. Yeah, I don't have a chart, Eddie. Are you in the trading room? Because we'll be talking about it tomorrow. All right. So anyway, again, we're actually over our time right now. So I've given you the general idea, the principles of trading volatility. I'm actually going to talk about in detail various aspects of trading options. But one of the new aspects, since I've actually done this workshop before, had really good feedback, but now we're really talking about volatility. Okay, I'm going to be talking in depth about UVXY and how it's been behaving for us over the past 6 weeks, how to manage the position, how to take profits, how to roll if we have positions going against us, how to roll that back out based on time and strike prices to manage that, how to look at volatility from the standpoint of the S&P 500, how to manage that. And then those of you that are a little bit newer to options, we're going to do a full review on the Greeks and time decay. I'm going to talk about the indicators that I use. I just touched on it right there when I was talking about the weekly credit spread strategies. I'm very, very, very consistent, very consistently profitable with these credit spreads because of the way someone asked, well, how do you pick the short strikes? That I use multiple factors, multiple time frames, and I will teach you that in this trading. Because it is something that is very a good opportunity for swing traders. People that, again, in the trading room, if you're familiar with it, I actually do a lot of intraday trading in the first hour and a half. I'm taking divergence trades with options. You know, we try to make profits every day. But our swing trading over 2 to 4 days, a lot of people like that. It's a little easier to get in and out. Okay, we're going to also talk a little bit about debit spreads and how to utilize that with specific price targets. And then again, I'm going to talk about the weekly credit spread strategy in detail. Basically, it's a how-to type checklist sort of trades. Okay, and then again, we're going to talk about value charts, value bars, all the value chart indicators, and the reversals that we use. But you know what? You don't need value charts to trade the strategies. You don't. And then we'll talk about the various profit targets and how do we establish that with these weekly options. So I look forward to being able to offer this to you guys. I'll tell you what, I mean, this is my offer to you for your time tonight. Okay. This is normally a $300 class. All right. And right now, I'm able to offer you this class for $97. You go to type in valuecharts.com/power or /power. Okay. I really think this is a tremendous value. All right. One contract in a credit spread using UVXY could easily pay for this. Okay. It's so powerful, the type of strategy I'm going to talk about, and it is different from what most people normally teach you. But again, I will teach it to you from the aspect, I'm not a pure options trader. I'm not sitting here talking about butterflies, calendars, iron condor spreads. I sit here and I'll tell you, I think we should do this because Apple is going higher. but we're going to do it with this type of protection because the exponential moving average is here. Momentum looks like this. You know, we have FOMC this day. Those aspects are what I think about. I don't necessarily do it based on, you know, I'm just here to do option strategies, because I've actually found that a lot of complicated option strategies are hard to implement and they're expensive to carry out. Okay? If you're doing an iron condor, you're selling 4 different options. With this, we're just selling 2. And a lot of my strategies, we just do directional type of trading. All right? I'm straightforward. And when I'm telling you support and resistance, all that kind of stuff, I didn't say just do a 2 standard deviation. But if you're just doing a mathematical calculation saying it should be 1.5 standard deviations away, it's not taking into account the current momentum picture or where support and resistance is. That's what I do. And again, if you're more an advanced trader, I would actually, hey, jump on this, because I trade differently than most people. All right? I started out trading futures. So direction and support and resistance is very important to me. Why don't I just buy puts and calls in a weekly? Good question, Hardy. Main reason is this. I like to do the 2 types of strategies, trading intraday and then trading weekly, because trading the strategy, these weekly credit spread strategies, those I don't have to stare at. If I'm trading intraday or even swing trading, I kind of have to stare at those because those are depreciating assets. Okay, I want to be right now. Okay, now with the weekly power option strategies, when I'm evaluating all these different factors and I'm doing it on a high probability type trade, it really kicks up my high probability type trading. Okay, and I try to limit risk. Again, I'll teach you that. Limit risk, limit your time risk, limit your loss risk. Okay, I'll tell you, the times I get stopped out at the levels I'm showing, most of the time those trades still work out. I just get stopped out because I'm like, okay, that's too much risk, I'm off. And then my other trades the rest of the week kind of counteract what I'm doing, and I end up still positive for the week. So the point is, I'll teach you that, how to limit risk, and the strategies I use in these weekly power option strategies. Okay, so for $97, folks, I can't believe that's how good a deal that is. I'll tell you, it is tremendous value. And here's my promise to you. I enjoy teaching people. All right, I'm not here to sell you something. I want you to learn these strategies so you can make money. All right, if you don't learn anything, or if you don't feel that you take this, you take some trades or whatever you want to do, and you say, Dave, that's not worth $97, I'll disagree with you, but I'll be honest, I'll return your money. I want to give you value above and beyond what I'm asking for. And if you don't feel that is, that's fine. I won't argue with you. But those of you that know me, those of you that have been in my webinars, know that the reason I'm here is so that you guys can learn. WL, no. Now, that's what I'm doing right now with UVXY. Am I comfortable selling UVXY at 55? No. Because I don't know what the overall market's going to do. I keep, for a week, I've been waiting for it to fall. Hey, if the market can go up when GDP is supposed to be 1.1%, that was the expected GDP number, and it comes in at 0.1%, it fell short by 1 whole percent, and the market can move up. I kind of shrug my shoulders and go, I don't know what else is going to take to move this market down. Okay, it's really choppy right now, and the NASDAQ is kind of leading everything lower. But that's the environment you play in. And what's nice about UVXY and the way we trade them is that we have time to make adjustments. It's not like we're trading an iron condor and with options that expire the next day. So if they go against us, it blows up and we just lose our money. So Yes, that is a good question. You guys notice that this particular Power Strategies class is Tuesday, May 6th. So it's like this coming Tuesday. Remember I said Tuesday's the day I sell credit spreads, and I do it from 3 to 4 o'clock. The timing of the class is like, oh, darn. Because I have you live trading the next day, Wednesday and Thursday. You get to see me manage the positions, but you're not there when we put them on. Guess what? The next week on the 13th, you guys are invited to the credit spread session. I'll get you the link at 3 p.m. That way you can actually see us put these trades on. Okay? And you can do it with us. All right? I'll get you in there on the 13th. 3 to 4. It's a timing thing. You guys will be like 2 hours late. 2 hours late. I'll also show you the credit spreads that we're in, because that way you can maybe put them in on Wednesday. You could do that, but you'll still get the 13th. Trust me. I mean, that's part of the fun. Part of the fun. Okay? Caesar, what's the percentage of maximum losses? If we're going in for 20 to 40 cents, and that's anywhere from a 4 to 8% return, and we're willing to take twice as much in losses, so you're looking from anywhere from 8 to 15% loss. Okay? Now, 8 to 15% loss on $500 is what? 50 to $100, something like that. Trevor, yes. What you can do, Trevor, with that the value bars special, contact support at microquant.com, and Min will be able to direct you to that offer. I don't have that with me. Eddie, you're having trouble signing up. Look in the chat box, guys. I gave you a link. I'm going to repost it, maybe because if people are just now getting in, take a look in the chat box. The link is right there. It's valuecharts.com/power. Oh, I'm sorry. That's showing up there. valuecharts.com/power. Anybody else having trouble? I'm going to type it in here. charts.com/power. I did it earlier. I just want to double check. You never know with yeah, it's there. You'll get to this page right there. There we go. So you just input your name. You guys know the drill. And name, address, all that stuff. $97. You can buy 2. You buy 2 of these, I promise you it'll be even worth that too. Then I just buy one. Buy one. All right. We're going to have lots of fun. We're going to learn a lot. And basically what I'm trying to do is give you guys some new tools that let you understand how you can really use the power of options, the leverage of options, the leverage of time. I mean, goodness, you're making money in a high probability trade as time passes. You can't slow down time, so you're going to make money just based on the fact time's passing. The live sessions are not recorded, Gary. Those are usually live trading rooms. Why don't you let me know? Because I'm trying to think if I have anything else for you, because it's the implementation and it does change a little bit. I'll see. You know what? I think what we'll do is we're going to record the 3 to 4 o'clock session so you can see how that gets implemented. That'll be something of value. Normal intraday trading, the May 7th and 8th, that's not going to be as much value. The Tuesday session from 3 to 4, that's where the value comes in, because you see how we evaluate that. But I'll get that to you. Just remind me. We'll work something out, Gary. I won't leave you hanging out there. But yes, the class, excuse me, the workshop itself, Tuesday night for 3 hours, it will be recorded. I process it myself. I usually have it up the next day. And you can get that from where you log in to valuecharts.com with your username and password. You'll have their previously purchased workshops, and there will be the strategies. Again, another thing too, I just kind of touched on it, but if you're in a workshop with me and you ask your questions there during the workshop, and then you walk away from the workshop, you start to implement the stuff, you have some more questions, you're always free to email me, and I'd be more than happy to work you through any of those questions that you may have. Again, I'm here to teach you. I want to make sure you guys have a good handle of on these strategies. Okay? That's where I feel I'm giving you a lot of value. Hardy, I'm not quite sure. Do you have one? Yes, I do have a one-on-one tutorial for students. That's a little different. That's another thing we offer our value charts people. No, it's a little bit out of what I'm talking about tonight. But if you go to valuecharts.com, go to one-on-one consulting. Basically, what this is for individuals already that are developing as traders, or even just starting out. What we do is we have a one-on-one session that focuses on helping you develop as a trader. Where are you currently? What is holding you back? What do you do well? What tools do you need, if you need any at all? I'm not here to sell you anything, but a good example is we have people that say, Dave, I like trading like this. I don't like trading like this. Well, the one that when you do trade well, I try to direct you some tools, some videos, even some workshops that we've had in the past that really would help that individual. I'm not here to sell you anything, okay? But when I see someone trying to develop as a trader, and I see that they're doing something well, and I can give them a couple of more things that can kind of really accelerate their learning, I'll make that suggestion. Okay? I'll make that suggestion, no problem at all. But go ahead and, if you find that might be value to you, go ahead and get that signed up. Yeah, Trevor, I'm glad. Eddie, I'm glad you're there. Anybody needs my my email, you guys, it's Dave. Oh, here we go. Dave, D-A-V-E, just Dave. At, oh goodness, I hate to micro. Quant, Q-U-A-N-T. See, you guys make me right. All right. Hallelujah. That's my email address. That's me. Doesn't go to my assistant. I don't have one. It's just me. Dave@microquant.com. So if you have any questions about the workshop, any questions about one-on-one consulting, any questions about the live trading room, feel free, or just in general, Dave, I was thinking about, the kind of this stuff. Send me an email, and I'll be more than happy to converse with you, see how I can help you. Okay? Oh, you guys are welcome. Bob, it may take a little while for you to get confirmation. Sorry about that. Here's the thing. You see how it says Dave@microquant.com? I want you to also know that we have support. U-P-P-O-R. Oh gosh. Support@microquant.com. If you have any difficulties, any questions on your billing, on your account, or you don't see a link, send it to support@microquant.com. We have a dedicated individual. He's really good. He helps me all the time. You send him an email, tell him what the situation is. He'll call you. He'll send you an email right back. He'll fix it for you. It's Min. It's not like we deal with thousands of people every day. We tend to be quite focused. We help our traders, and Min will get you straightened out. No problem at all. Yeah, Min is great. He's great. So, okay. So that's my offer for you guys. I mean, gosh, please join me next Tuesday. I really think it's going to be a very, very good session. It's going to be great. But again, most importantly, I think you're going to get tremendous value. If there's problems with you not making it, or you're concerned that you're going to be watching the video, don't, because I've had people take my video workshops before. They'll sit and listen to the whole video, take notes. If they have any questions, they'll listen to the video again. But then they'll shoot me an email, say, Dave, you said this here. Can you explain that a little bit more to me? And I email back. But if I feel like I want a little bit more back and forth, we'll set up a time, talk on the phone. We'll get it all straightened out. Don't worry. Okay? I mean, that price amazes me. It's such a good value. All right? All right. Well, I've been keeping you guys for an hour and 25 minutes. So I know some of you guys overseas, especially. One gentleman in the UK. Oh, my goodness. I'm just thinking about what time. It's almost like 3 o'clock in the morning for that gentleman. So I'm going to let you guys go. Again, you have my email. If you have any questions, dave@microquant.com. Happy to do that. If you have any difficulties at all, contact support@microquant.com. I just want to say thanks again. I mean, I know some of you have told me that you signed up. So I know there's probably 20 more people that have signed up that didn't say that. So I just wanted to say off the bat, thank you. Thank you, and definitely will have tremendous value for you next Tuesday. Okay? Everybody, you're welcome. Thanks a lot. Again, I'll leave this up so you guys can see it, and I'll turn it off in a couple of minutes. But if you want to look at the recording of this webinar, give me a couple of hours in the morning to process it, and then it should be up on valuecharts.com, our blog. Just go to the video. You'll see Weekly Power Option Strategies webinar May 1st, and it'll be up there for you. So again, let me know if there's something I could do. Thank you again, and have a great, safe, and relaxing evening. Markets are open in the morning. Thanks. Bye-bye.